The stock market is telling us right now that the economic recovery is going to be just about as powerful and swift as the collapse. What do you think?
I think there are a couple things to keep in mind. One is we've had an extraordinary amount of stimulus. If you add up monetary and fiscal stimulus as a percentage of GDP, it's about 37%. That's an extraordinary number. So the market is right to respond to that. I think we're going to transition, however, from monetary and fiscal stimulus headlines to leading economic indicators and earnings, and that's probably not as positive of a tale in the near term. So as we look out, we think on the equity side right now, things are probably around fair value. On credit, we see a lot of value. I think you have to divide really from an asset allocation and a macro standpoint. What are you trying to achieve? When we look out towards 22 and 23, remember most of our capital is kind of 7 to 10 year capital. We see a lot of value, and we see secular winners around e-commerce, around I would say value concepts as in people trade down. We think there's going to be a big theme towards nesting or people doing more around their working from home or similar type behavior patterns, what we saw post 9/11. But this is not going to be a straight line. The VIX is at 40 for a reason, and it's telling you there's still a lot of uncertainty. I think you and I have talked about this recently, but look, the U.S. just lost, unfortunately, and there's a massive human element to this. The U.S. has had 22 million people on the unemployment tally in the last 4 weeks, which is extraordinary by any measure. So it's going to be a different recovery by country and by region. We're seeing very attractive green shoots out of China. I don't think China is the playbook for all countries, but I do think that you can say there's going to be a recovery. It's coming, but it's going to come from a big hole.